Good afternoon, ladies and gentlemen. In this cloudy atmosphere of quarterly earnings, there is a rare sunshine, a ray of sunshine that's coming in from DCB Bank, where quarterly net profit is up 22% year on year to 184 crore rupees. Net interest income surged 15% at 624 crore rupees. There is a drop in gross NPAs to 2.72% quarter on quarter, as also a similar decline in the net NPA at 1.1% sequentially versus 1.21% in the previous quarter. To discuss this set of earnings and the way forward, we are now joined by the top management of DCB Bank. Mr. Praveen, Kutty, MD at the bank, joins us to discuss what the crystal ball holds. Good afternoon to you, Mr. Kutty. As I was saying, a rare dose of sunshine in an overall cloudy quarterly earnings. What brought you to this level, both in terms of NII and profit growth? Your bank is trading at a 6-year high. Again, like I said, bright sunshine.
Good afternoon. Thank you very much. You've been very gracious. What you're seeing is basically the culmination of a lot of effort that we've put into over the last 5-6 quarters. So we basically are looking for getting the basics right, keep doing the same, what's right over and over again, aim for consistency. And what we really like about the quarter are two things. One is the consistency, and the consistency is not just over the last year, but also in terms of practically every line. If you were to see the net interest income, if you were to see the fee line, and multiple lines in the portfolio quality, we've done better. So the only area where we've been equal to the last year is in cost to average assets at 2.59. And that primarily is because we took a 26 crore hit as a one-time hit because of the new labor code. Which brings me to the second point, which is the resilience of the team. We could afford to take a 26 crore hit. It's a big hit, for a bank of our size, and still post results which are the highest ever in terms of quarterly profit. So both from a consistency perspective and a resilience perspective, there is a lot of happiness in what we have posted.
Fair point. Now let's dig a little deeper and let's look into the future as well. Strong deposit and advance growth, very, very high teens, 19.5% for deposits, and advances grew at 18.5%. Any specific zones in terms of geography, any specific sectors in terms of industry where you are seeing rising demand, both Q and Q as well as year on year, Mr. Kutty?
So the clarity is in terms of the product. What we do is we look at secured products, we look at granular low ticket size, roughly around 30 lakhs kind of ticket size. We have tweaked our model to skew more in favor of business loans, secured business loans over home loans, and we see increasing demand in this particular segment. Decent GDP, good inflation numbers coming through, good domestic demand. The policies in terms of PLI and GST are helping the tailwind in some way, and good monsoons and rural infrastructure improvements probably augur well for the future as well. We clearly are in the SMEs and the agri segment, and we are seeing demand improve there, and more importantly, the quality of repayment improve there.
Okay. Let's just discuss this quality of repayment a bit more. There is a sequential reduction in both gross NPA and net NPA. Essentially means that Q3 was better than Q2. Now, is this because advances and advances have risen? NPAs could have remained stagnant and you would have had higher advances, therefore the percentage is lower. or were you able to somehow convert some of the non-performing assets into paying assets?
So there are three things I want to draw your attention to. One is that there is a improvement in multiple areas. You're seeing a bounce rate improve. You're seeing the new vintage sourcing of a better quality than the previous vintages. You're seeing a higher recovery. And let me spend some time here. 86% of the fresh NPA came back as upgrade and recovery. So that's a percentage we never touched in the last 2-3 years. Maybe definitely not the last 3 years. We were hovering around the 80% mark. So 86% recovery and upgrade clearly indicate that there is the ability of the customer to pay more than one EMI back to us. Of course, the denominator growing always helps the percentage, but more importantly, looking at the future, the short-term future, I expect the NNPA to come down to 1% or less, and that's a first step in our journey in this regard.
Okay, 1% or less in the next 1 quarter, or maybe 2 or 3.
We should see that happening, and we're working really hard on ensuring that these kind of tailwinds, the benevolence of the better bounce rate, the new vintage sourcing, that has to translate into something meaningful, and that is the first step in that is get to less than 1% of NNPA. So let's see how it goes. I mean, I would tend to think directionally we should be seeing that going forward in the quarters to come. When we'll get there, I'm not too sure of, but the management is working really hard on improving this further.
Well, whenever you get there, I'm sure you and I are going to discuss that threadbare in the coming quarters, and good luck for that in advance. Before I address the elephant in the room, Mr. Kutty, I would just like to know, how was branch expansion physically? How is the digital space for DCB Bank working? And what are the fresh investments you are making on both these platforms, physical expansion as well as digital outgrowth?
So over the last 2 years, what we've done is that we have ensured that the productivity goes up. For the first time ever, our business per employee has crossed the 10 crore mark. So effectively, what you're seeing is a reduction on the employee base. So we've actually gone the other way and ensured that the productivity increase happens. The 18.5% growth in assets and the 19.5% growth in liabilities had come with a 2.5% reduction in the employee base. And in trend with this, the number of new branches that we have put in is about is fewer this year. We should end the year with about 480 branches. We currently have about 469 branches. So the key, maybe even for the next year going forward, is to ensure improved productivity of the people that we have. We are still a people-led growth company, so there will be an increase in people, but not too much of branch expansion coming through. Where we are putting in our bets is in ensuring that we are very much in the midst of paperless loans, secured loans going through. On the ULI, we are very, very keen with increased digitization of the mortgage documents. We will see dramatic efficiency improvement, cutting down a cost, and TAT improvement happening. It will also mean that the customer would get a better price, a better rate, interest rate on the products that we delve in. So secured loans, digitization is a big element. There's a very healthy use of AI happening in the bank, primarily in areas of voice and chat, which is giving us a much better understanding of customer satisfaction, better turnaround time. We continue to invest very heavily. Our tech expense as a percentage of OPEX is one of the highest in the industry, but take that with a pinch of salt because our overall expense base is pretty low. But the fact remains that tech investments, both in terms of securing the guardrails, the tech guardrails, and also in terms of ensuring better efficiency for the front line and swifter, seamless conversion for the customer is top of the mind as we go along. And it will remain so in the foreseeable future as well.
Okay. Now let me address the elephant in the room, which is loans against precious metals, gold and silver. How did that business fare? What is the existing NPA in the gold loan business, and has it, because prices have gone up, seen an increased contribution to overall loan portfolio?
Yeah, I mean, the price have really skyrocketed. Gold around 15,000 rupees per gram, unbelievable. So that has helped the cost. NPAs are negligible. And even though the NPAs are negligible, the real loss rate is very, very low. Because nobody would want to auction their gold at this particular point in time. So I don't see that NPAs currently, if you look behind their shoulder in the past, there will be an issue. But if the prices were to come down drastically, that could create an issue going forward.
Okay. 2 quarters down the line, 3 quarters down the line, where is the maximum growth coming in for DCB Bank? Is it retail? Is it corporate? And if corporate, which sector?
It's certainly retail. It is retail, small ticket size retail, which is secured. That and it doesn't have a location preference. We as a bank, we're not regional. We are 28% metro, 28% urban, another 27% semi-urban, and about 18% rural. So it's very well spread across, and we're finding similar kind of demand happening across. I mean, location is frankly not either a concern or not a gain in that sense of the word. So clearly, secured assets of 30 lakh plus, which is our sweet spot, we think it's a good space to be in for the times to come.
Okay, Mr. Kutty, in August and September last year, we saw a very decent cut in GST rates for consumer durables, as also a drop in interest borrowing costs across the board. Because you are affected on both sides, lower borrowing costs essentially means your NIMs get impacted, but a drop in interest rates, a drop in GST rates means that demand soars for loans. If you could just juxtapose these two and draw us a picture for our viewers that how did it work out?
I think the simplification of GST has really helped. We're seeing the immediate impact happening in terms of repayment. A portion of the success we would attribute it to the simplification of GST 2.0. That's very, very clearly it. In terms of demand, we do quite a lot of loans which is based on texture and context, where the customers actually not in the formal arena, so to speak. So that impact you will see coming in later. But clearly on the repayment side, you're seeing that there is a bit more money in the pocket for the customer base that we serve, and the benefit in terms of bounce rates, low slippage, translating into lower defaults and consequently lower NPA. I think it's playing out clearly. That's one of the elements which is playing out. On the rate cut that you spoke about, we haven't absorbed the full 25 basis point rate cut that happened in the middle of last quarter. You probably will see that the full impact happening in Q4. But having said that, I still think we have seen the bottoming of the NIM in this particular cycle. If you look at net interest income, which is basically the interest earned on the total deposit, our NII is slightly higher than the NII that we had in December of 2025, 2024, which means before the rate cut, we are slightly ahead of the pre-rate cut NII. On the NIM, we're still 3 basis points below, 330 to 327, but I see the upward trend continuing in Q4 and then onwards as well, if there are no further rate cuts.
Fair point. On that note, Mr. Kutty, we'll call it time. Here's wishing you all the best. We look forward to NPAs below 1%, net NPAs below 1% fairly soon, and that a 6-year high on DCB Bank is already there on the charts. We hope for a record high, which is above 240, and great goings ahead, and a Happy New Year.
Thank you very much. Happy New Year to you too, and always a pleasure speaking to you.
That, ladies and gentlemen, was Mr. Praveen Kutty, MD at DCB Bank, discussing the quarter gone by, where earnings rose 21% and net interest income was up 15%. The bank is trading at its highest level since Jan 2020. Thank you for watching. There's more ahead on Business Today Television. Stay glued.